There is always a point in time in which you're going to feel really foolish as an investor. You either feel foolish on the way up, you feel foolish on the way down. Everyone's going to be made to feel foolish at some point, right? Like that's just the nature of investing. I'm trying to remember who said it, but they said like, investing is just a decision of being right now or being right later. Sometimes even as what we think is to be longer term investors, we fail to remember that even when we label stuff long term, we still have so much recency bias and we're probably still talking somewhat short term.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey everyone, welcome back to another episode of the Tall Oaks podcast. I'm your host, Branden Ducharme, and I am joined today by a friend of mine, Joe Hegener of Asterozoa Capital. And Joe has an interesting segment of the market that he has worked his career in. Joe, correct me if I'm wrong, but you kind of grew up in a career sense at PIMCO, was it, right?
BlackRock first, then PIMCO.
BlackRock and PIMCO is kind of viewed as the bond. Those are the bond guys, you know. And so, like, if you don't mind sharing just 2 minutes, what was your kind of background there? What's your experience, and you know, what are you focused on in your career?
Sure. Yeah. Thanks for having me on. It's good to see you. So when I was at BlackRock, I started in a group called the Risk Solutions Group. And that was predominantly using risk factor and parametric analysis to try to better understand not just fixed income, but actually multi-asset portfolios from a quantitative standpoint, determining what the value at risk numbers in various regimes might look like. How do multi-asset portfolios work together under certain correlation assumptions, and then kind of stress testing analyses, everything from manager due diligence all the way to kind of asset class optimization, and leverage the Aladdin system there. I was in the Aladdin business actually. And then from there I went to PIMCO, and that was more of a traditional portfolio management type role. Of course it's a fixed income shop. And I worked for a guy named Jerome Schneider in that desk that he oversaw, managed about 125 billion across a number of different fixed income mandates. After that, I ran a hedge fund for a couple of years. I've spun out of that, and I built the company we have now, Asterozoa Management.
Very cool. I appreciate that. And I think before everyone turns it off and says, oh man, the guys are talking about the old boring bonds, like, Branden, you're not a bond guy. What's going on here? And we're talking about the old exciting Michael Milken segment of the market, high yield bonds today. And so here's the deal is, if anyone that's taken economics, I remember the first time I really actually heard this term was in my econ class in college. And my professor always called them like junk bonds. And I was like, what? Who would invest in a junk bond? It's called a junk bond. You know, who buys junk? And the answer is people that are looking for a higher yield and have the capacity to still diversify. This was a more challenging thing traditionally, right? So only people with huge amounts of capital would be able to actually diversify a portfolio of junk bonds. But with the rise of mutual funds and now ETFs, it's been a lot easier, exceptionally easy, right? However, what I don't see very often is portfolios where people have an allocation to high yield bonds. I would say it's very, very uncommon that people come into our firm, have us look at their portfolio they have existing, and it has any allocation to high yield bonds, right? Let alone any kind of core position or well thought out idea, and just totally overlooked. And the reason why is, I think, in the numbers and the recency bias of what's happened in markets the last 18 years now. So I've got some data here, Joe, of HYG, which is a high yield corporate bond ETF. So this is kind of like the high yield index fund relative to the an S&P 500 index fund. And it goes back to May of 2007. Well, since May of 2007 in the high yield bond space, you've got an annualized return of just shy of 5% in high yield bonds and just shy of 11% in the S&P 500, 10.6%. And, but your max drawdown, which is a risk metric I like to use, which is max drawdown's like, when it gets bad, how bad does it get? Is kind of the way I think about max drawdown, right? Well, in high yield bonds, in I can tell you both these max drawdowns were from the '08 time period. 30% loss in high yield bonds and 50% loss roughly in the S&P 500. And the benchmark correlation between them is pretty high, right? So generally the direction that stocks are moving, high yield bonds are moving the same kind of direction, right? Very sensitive to the same economic drivers, right? And so what that leads to is over the last 18 years, if you've invested in high yield bonds, you got about 43% of the 43.8% of the upside return capture of the S&P 500, but only but you also got 49% of the downside. So you got you cut off both upside and downside, but you cut off more upside than you did downside, right? And you go like, that doesn't make sense for a lot of people. They're a negative alpha instrument at that point. So the last 18 years, you would have been better off theoretically if your time horizon was 18 years to just say, well, I'll just own less S&P 500, right? If I don't like all the risk of the S&P 500, I'd actually be more efficient just owning less owning less equities. But what's interesting is we've had this entire era of zero interest rate policy, right? Coming out of '08. So that data started in 2007. That's when HYG in particular was launched as an ETF. That's why that was the beginning data point I used. And so we had suppressed interest rates. Hey, that's bad for bonds, right? You get paid on yield. So high interest rates is good for bonds once the rate's there. The path to get there, not good for bonds, but once you're there, it's great. And then we had, all the QE policy that, for lack of a better term, pumped the bags on equities, right? Stock market has done historically well. It's been one of the best bull markets in history. And so sometimes even as what we think is to be longer term investors, we fail to remember that even when we label stuff long term, we still have so much recency bias and we're probably still talking somewhat short term. So what has the stock market done the last 20 years or 18 years versus high yield bonds the last 18 years is actually a pretty short term time frame in a lot of respect, right? Like, now that's subjective. However, like, just because it did it last 20 years, if you extrapolate that forward and say, well, that's what the next 20 years should be like, you're going to probably start running into some issues, right? If you're looking at a cyclical cycle and saying what happened the last 3 or 5 years is maybe likely to happen in a couple more years, that's different. But what happened the last 20 years, going to happen the next 20 years, I got to disagree with people on that one, right? So what I was interested in is if I go back and pull a further history on high yield bonds, inclusive of what happened post '08. So including all this horrible 18 years of, not really horrible, but unfavorable 18 years of high yield bonds. The oldest high yield bond fund I could find it's from Vanguard, and it goes back to 1985, and so does their S&P 500 fund. So we're going to look at two Vanguard funds, high yield bonds versus S&P 500, right? How'd they do? Well, stocks once again beat high yield bonds, no doubt. 7.3% return annualized for the bonds and 11.78 for the S&P 500. Once again, great return. So what is the difference? Well, you have significantly less volatility. Your max drawdown is significantly less. And when you go to that upside downside capture, you put it in your favor. So you got 35% of the upside, but only 21% of the downside. And that is the metric, I think, where you start to look and say, okay, well, bonds throughout an entire market cycle, if you're trying to run like an institution and say we have liability matching to do, we need to be able to predict our cash flows. We have access to the institutional leverage. You can all of a sudden flip the script and say, it's actually a more efficient instrument for them, right? It's more predictable. It's actually lower risk. And so when you look at it through that lens, all of a sudden there is a really compelling case for bonds. Now 85 is pretty much at the top of probably the interest rate market, and interest rates started coming down from there. It was a great tailwind, but it also included the the 18 years on the back end that weren't really favorable. So I think looking at the general picture, the reason I share all that information with you, Joe, is first off, you've been on the other side of the table of the institutions at the big shops and talking with the people that manage, millions and billions of dollars in a portfolio. I work with Main Street, and so in my perception, right, what I'm often trying to do is take clients on Main Street and treat their personal financial life the same way that an endowment fund treats their assets, or a pension fund treats their assets, right? Which is you have to try to liability match out the incomes, the outflows, right? Project all that out and make sure that money's available when you need it, and also available for the times that you're not expecting to need it but may need it, right? And so all of a sudden liquidity, balance, volatility, use of leverage, it all comes into play, right? Am I perceiving that wrong? Is there anything you want to add to that? And then B, I want to talk about what is the state of the current high yield bond market, and especially relative to equities right now, and where do we think we might be going?
Okay. Wow. All right. Yeah. Well, there's a lot you just unpacked there. I would say, yeah. I mean, I kind of first and foremost, the looking back, the high yield bond market, or rather when this asset class was just sort of blossoming in those milken days that you referred to, right? It was a very different marketplace, right? Not only were interest rates and therefore yields substantially higher, than like you alluded to than today, but the players were also much different, right? The proliferation of mutual funds and accessibility to this marketplace has actually increased the correlation between equities, in my opinion, and high yield debt, right? I mean, back in the 80s or 90s, you could have a junk bond or a high yield portfolio that yields into the teens, right? And that's an interesting proposition, right? It's a loan that matures in oftentimes 5 years from now. I'm going to get 15% of my money back after year one, and I'm getting it importantly in the form of income, right? That's a key distinction I think we need to make here as it relates to the marketplace itself, even in today's environment. Even if we reverse, if we go back a few years, back when rates were indeed zero and high yield spreads were quite thin and high yield bonds were only yielding 3%, 4%, 5%. Even in that scenario, there are still trillions of dollars of embedded structural investors vis-a-vis the institutional complex, right? If I'm an insurance company or a pension fund, I am required to do asset liability management, right? I have X amount of liabilities and X amount of the stream of cash flow that I'm due to pay over the next 50 years. And I need to take the assets that I have now and match those liabilities with income producing assets. And that's something that as a retail investor, you don't necessarily have to do. I mean, you might have mortgage payments, saving for, your kid's college fund, and, certain liability streams in the future, but it's far less predictable, and they typically tend to be a lot chunkier than institutional liability streams. And so even in low interest rate environments, you're still going to have a massive complex that are going to be investing in income producing assets, regardless of where interest rates are. The fact that the Fed raised rates by 500 basis points, just makes, in our view, the asset class more compelling, right? You mentioned, if we go back to 1985, I think you said something like, 30% or 20% of the downside for 30% of the gain, something along those lines. The risk adjusted return, I think, is what we're focusing on here. What kind of risk do I hold? And what kind of gain can I expect on a going forward basis? Over the last 15 years, as you referred to or mentioned, it's been a pretty epic bull market, particularly in the last 5 years. It's been an unbelievable success story for equities. And it's our view that that's not sustainable. It's entirely possible it keeps going for a while. But historically speaking, these types of run-ups in valuations within equity markets, come to an end inevitably. And Oaktree actually put out an analysis a week or two ago that we thought was pretty interesting, where, effectively speaking, if you're investing into the S&P 500 at around today's valuation, from an historical lens standpoint, you should expect anywhere between -2 and 2% annual returns in the S&P 500 over the next 10 years. And that's just using long-term capital markets assumptions, but it's, historically speaking, actually a pretty accurate model that they're citing. So on a going forward basis, particularly here with equity valuations at nosebleed levels, from a risk standpoint, a risk adjusted standpoint, am far more comfortable investing in fixed income securities that I know have a maturity, where I am getting, the treasury rate plus 300, 400 basis points. I mean, that's 7% yield, 8% yield that I can hang my hat on at the end of the day. In today's context and over the next 10 years, I really don't think that's much to scoff at. And then we can get into it, but there are ways of kind of hedging that risk. Another key differentiator that you also mentioned just now was the difference between bonds and equities, of course, is that there's a kind of an asymptote as it relates to how much a bond can appreciate in value, right? If the bond is going to mature in a few years from now, it's not going to trade substantially above par, right? Even if market conditions get super frothy and interest rates are getting cut substantially, there is an asymptote there as it relates to how much it can appreciate versus the downside risk. If this company goes into bankruptcy and maybe it's an unsecured security, there's potential for total loss on the investment. So that's actually very negatively skewed to the downside in that type of scenario, where at least in equities, a stock, there really is no limit or asymptote as it relates to the upside value. The valuations could get further and further into nosebleed territory. And we, of course, know that doesn't end well, but at least the upside is not capped the way that you would see within the high yield bond market. And so generally speaking, when we see prices drifting into that territory that are kind of bumping up against that asymptote, it gives us as active investors a little bit of a pause. Maybe we look at hedging some of our risk or actually taking the other side and being short some securities we don't like.
I think what you're highlighting there, right, is the math in what I'm going to use some air quotes here, like bond land. The math is still the math, right? Like the old fixed income securities handbook, right? Fabozzi's math, Fabozzi's book, it still plays out. It is what it is, right? You can't now. There can still be some irrationality that occurs, right? No doubt. But if you say, like, I have a contract where I borrowed somebody $1,000 for 5 years and they're going to give me $70 a year for 5 years and then give me my $1,000 back. There's like, if the probability of that bond defaulting and them never paying you back goes up, then, and you want to get your cash now because you're worried, maybe somebody will only give you $800, right? And take over the future, payments that they're going to make, and they'll worry about collecting. But, if they make good, they get to collect the full 1,000, right? At the end. That's sort of the trade-off. But what's really tough, and what you're illustrating is, it's really tough in that case for you to go, hey, this person's really likely to pay me back. And if you go to borrow money, you try to lend money out in the current environment, someone's only going to give you $50 a year. So, I'll sell you my obligation that I own from this guy. Instead of 1,000, you can give me 1,100 for it, right? Or 1,500 for it. It's just, there's a limit, right? Yes. And it's because the math still has to work, right? Like you can't really speculate because the return profile is entirely in the contract. It's endogenous to the investment itself. Whereas like S&P 500, you can just say like, well, I think it's worth 6,900 today. No, I think it's worth 7,000. You know what I mean? It's like, is it worth 7,200? Is it worth 5,600? Right? It's just much more difficult to value. And I don't know that I want to say value, but it's much more difficult to get right the assumptions of what the market is going to be willing to pay, right? So it's much more difficult to predict the price.
Without a doubt. That's the reason why I like fixed income, to be honest with you, is it's fixed. I know what I'm going to get paid, and I can easily manage the risks around those knowns, right? If you're an equity analyst and you're trying to come up with a price target for the S&P 500, so much of that is nebulous. It's a function of market psychology, inflows into the system, liquidity, animal spirits that are definitionally not quantifiable. Whereas, fixed income market, has its cons, obviously, but at least I know what I'm getting into in terms of the coupon payments I'm going to receive every 6 months, maturity at the end, and I can easily build math around that to build a dynamic portfolio.
Yeah. Well, and it's like you said, it gives you the opportunity set. If all of a sudden you have a bond that, you lent at 1,000 and now it's trading on the market at 1,100 or 1,150, you're going, there's no way. Like, I'll sure, give me my 1,150. I'll close out the trade now. I don't need those last two payments. You're basically giving them to me right there. I'll take my full return and I can sit in money market and look for my next opportunity. Right.
Yeah, just to give you an idea where we are in the market right now. I mean, just a few months ago, we were participating in new issue bond deals at par. And 2 months later, we were selling them for 105, 106 cents on the dollar, just to give you an idea of the amount of demand currently out there.
Yeah.
And, granted, it's come in a bit, the risk appetite, but there's still insatiable amount of demand for risk right now. And, if you are somewhat of a contrarian investor like we are, we're taking the other side. I'm happy to be cashed out at 106 right now and be out of the trade and take the 6% gain within, several weeks, as opposed to, what investors are doing now is they're paying up for the right to have a cash flow stream for the next 5 years. And so that would be operating under the assumption that interest rates are going to fall and credit spreads, importantly, are going to stay the same or tighten further from their already very tight levels.
Yeah. That's a really good point. Do you have any insight that you care to share on where credit spreads are at currently, and where they are relative to like a historical expectation?
Yeah. So, credit spreads on average typically hover around 400 to 450 basis points over treasuries. It's a very rough math.
So that's 4 to 5%. 4 to 5% over whatever money market's going to pay.
Exactly, or the reference rate, which in that case would be the 5-year treasury. There are a few gigantic gyrations around that. When there's market panic, those spreads tend to blow out very substantially for a pretty short period of time. And then when cooler heads prevail and people realize that 50% of America isn't going to default on its debt, those spreads typically come right back in fairly quickly. But just to give you an idea, right, high yield spreads going into the March of 2020 pandemic shock went from about 280 basis points, or a little less than 3%, to 15% over treasuries, back down to 3.5% to 4% in a very short period of time. So you get these giant spikes, kind of like an inverse VIX, or rather, it would be positively correlated VIX. You get these giant spikes, which we actually see as very interesting opportunities to try to manage around as contrarian investors. But if you focus on where we are today, we're at about 300 basis points or 3% over treasuries, which is all in yield of about 7% in the context of the next 10 years, especially versus equities. That's actually pretty attractive in our view, but purely from a spread dynamic, 300 basis points over treasuries is very tight, historically speaking. Like all-time lows would be another 50 basis points of compression from here. And so the risk there is very skewed to the downside in our view, just given the amount of uncertainty about what the world might look like in a year or two from now, relative to the amount of yield you're getting in excess of a risk-free rate. We view that to be not particularly compelling, and we're actually kind of on the other side of that trade with the purchase of credit default swaps, which of course are like an insurance policy against spreads widening.
In the sense that if the spreads widen, the bonds go down in value, and if you have the credit default swap, then you get paid when the bonds fail, right?
Exactly. So there's two ways you can do it. Go ahead.
I was just going to clarify, and that's that's a derivative contract that that derivative contract itself then trades on a secondary market. And so the bonds don't have to actually fail per se. as the spreads widen and the likelihood of them failing increases, that actually naturally increases the price, the market price of your derivative contract, your option. Essentially, it's your swap, and so you can monetize that on the open market without the bonds themselves actually ever failing, right? So you can capture the protection, but it's not an all or nothing trade.
That's exactly right. Yeah. That's a very important distinction, right? The bonds themselves, the reference index or the reference bond that you're seeking protection against, don't have to fail the way that they did in 08, for example. That would trigger a huge payout, right? People just have to be sufficiently nervous enough about the possibility of failure effectively, where the spreads would naturally widen in conjunction with the rest of the market sell-off, and you would be able to monetize at any stage.
Yeah. You're more or less taking an insurance policy out on somebody else's house, and, they didn't want to buy insurance on their own house, and now they're, they got some smoke in the kitchen starting, and here you are standing ready to sell them their insurance policy, but they're going to be willing at that point to pay a lot more than they were going to originally pay, right?
Yeah, that's a good analogy.
Yeah. Now the downside of that is if their house never catches on fire, you burn some premium, right? On buying that insurance policy.
Exactly. And that's the unique kind of proposition that we're trying to take advantage of is it costs money to pay the insurance premiums every day, every month, every quarter. But as long as you're managing a high yield bond portfolio that's kicking off sufficient income, we're happy to take a portion of that income and purchase the protection.
Yeah.
Now, if it's a different style of portfolio, it might not be as conducive to necessarily paying up for these types of swaps. But again, that's a case by case basis.
Yeah, I think if you look at where bond valuations, if you will, right, where bonds are trading right now, where where how tight the spreads are relative to historically tight spreads. And you're sort of looking at the insurance policy on your neighbor's house going like, I know your kid plays with matches, dude. Like, right. It's kind of like you're like, it doesn't have to happen, but man, it's a really compelling case to say, I think you guys are a little crazy next door. Right. And so you have an opportunity to buy that, but since nothing's happened yet and the insurance company, doesn't know the little kid's an arsonist or whatever, you still get it at like a cheap price, so you can buy it at a cheap price. And if it pays off, it's going to pay off huge. And as that likelihood increases, it can begin to pay off. Right. And at a certain point you can say, okay, I've made enough. And at a certain point, I think the beauty of this is the convexity that these type of hedging activities in a space that's more calculatable adds to a portfolio, because all of a sudden, not only do you make it on the way down, right? So like, if not only can you avoid the big, catastrophic loss yourself, but if you have cash to reinvest at that point, like when the spreads are really wide, like you're talking about some really, really nice opportunity, right? So, that's, it's really tough to get right. I don't want to make any disillusion about that. But
the nice thing is that it's relatively inexpensive to take the risk, right? That's what we try to focus on as investors, are asymmetric opportunities. And just to give you context, right? Like an interesting case study that we're looking at right now is Peripheral Europe, right? And so in full disclosure, I've got a major bias against Peripheral Europe. One of the most interesting projects I got to really kind of look at from afar when I was first starting at BlackRock is the Financial Markets Advisory Group of BlackRock. They were hired by the Central Bank of Greece and ECB during the European debt crisis. And so that team got to really go in and do a full forensic analysis on the state of the balance sheet in Greece and elsewhere, helped the ECB craft their quantitative easing policy in Europe, which was actually materially different from what the US did. And it just gave us an interesting line of transparency into how these economies and governments worked. Just crazy things like the percentage of people who actually pay taxes is unbelievably low relative to, kind of the UK and the US and in Germany, and the productivity levels, demographic trends. Like the whole point of quantitative easing in the Eurozone was to jam rates to zero to give breathing room to all these insolvent countries who had enormous amounts of debt as a percentage of GDP, and the interest rates were in the teens. It was like credit card debt, and it was starting to unravel and become unsustainable. And so by Mario Draghi taking the bazooka and bringing rates negative in Northern Europe and down to zero in peripheral, all of a sudden that debt became much more palatable and sustainable. It was very inexpensive to maintain, even though the debt to GDP ratios were quite high. And so for 10, 15 years, we bought the breathing room to enact reform and austerity and right the ship, but governments never did that. Actually, ironically, Greece did a great job in the last 5 years. All the other nations in peripheral Europe, France, Italy, et cetera, they just gorged on more cheap debt. Like arguably every single one of the metrics that I just rattled off in terms of what makes a company sustainable and solvent is arguably worse now than leading into the European debt crisis of 12 and 13. And yet peripheral sovereign spreads currently are close to zero, right? The spread over bunds for the Italian debt is about 40 basis points. And so what that means, and interest rates are no longer zero, right? I mean, they're going the wrong direction. Now, I'm not sure if you've seen the Japanese 30-year, the euro, Cuban 30-year. This debt is expensive to maintain now. And in my opinion, it's not sustainable. And yet I could buy $100 million worth of notional exposure, effectively of a payout that would come to me if the country of Italy defaults on their debt. And it would only cost me like $400,000 or 40 basis points per annum of premium to pay on that insurance policy. Now, I would argue, I'm not saying Italy is going to default on their debt. I'm not saying that. I'm saying it's way more likely than paying for $400,000 for $100 million of protection. I think it's, if you assign it a probability weight, I'd say in the next 5 years, maybe it's a 25%, 30% chance that Italy defaults on their debt, not a 1% chance, which is currently what's priced in. So there are really interesting little asymmetric opportunities that are out there whereby we're only allocating a small percentage of the income that's being brought in order for these kind of interesting asymmetric bets to the upside if there is a left tail scenario.
The beauty of this is it's so much more math driven, right? Like these conversations are so much more math driven. And when you run your life or run a portfolio on probabilities, eventually, and you put those probabilities in your favor, right? They eventually, the more you do it, are likely to work out, right? Which is so much more difficult than dealing with on the equity side, where things can be so irrational for so long for such unexpected reasons, right? And so bonds, this is why bonds are the instrument of the institution, right? But they oftentimes look really boring, for lack of a better term, when you just look at like a bond mutual fund or a bond ETF. The advisor, the financial advisor shows mom and dad some, a couple US ag bonds. It's got some mortgages in there, some 10-year treasury, some 5-year, and maybe a little bit of investment grade corporate, and you go, yeah, so that should, we expect that to make 4.5% a year. It's like, well, it's kind of boring, and I can appreciate that. Like it is what it is, and there's a use case for it. But I think most people just look at it through that lens, and they forget that bonds really run the world, and equity markets are, I don't want to say small and insignificant relative to bonds, but trouble in the bond market will spill over into the equity market. I'll put it that way, right?
Without a doubt. Yeah. I mean, a good piece of advice that I got when I was just starting out my career, graduating from school was, kid, start in fixed income. And if you learn that and you don't like it, you can always move over to equities. But if you start in equities, it's going to be very tough for you to transition into fixed income. And what he meant by that was, the bond market or the fixed income market, right, is really just an analysis of the capital stack of the same company, right? I mean, Coca-Cola stock, right? There's also billions and billions of dollars of debt at various maturities with various, covenants and seniority that are ahead of that equity in terms of priority of cash flows. And so if you're a fixed income investor, you need to understand the whole capital stack. How does the earnings of the business waterfall through the capital stack and pour out what's left over into the equity position, which would drive the stock? Now, if you're a stock analyst, right, or an equity analyst, you're just focusing on that little sliver at the bottom, and you're really not paying any attention to anything up on top that's senior to what's affecting the cash flow. Right. And so it's very different. The equity analysts coming up with price targets. There's all sorts of thing about comps using market sentiment, and I just it's not rational enough for me. And to your point, right? Typically, when we do get bear markets, the bond market, historically speaking, senses that a little bit more quickly, I think, than the stock market does, because what drives the bond market is actual fundamental impact to earnings at the end of the day. Is what's the risk of this credit? How likely is this business going to be around in the next 5 to 10 years?
Yeah.
And when those bond prices start to dip dramatically, that's saying something about the state of the economy at large, and it really is inevitable for the stock market to then follow.
Yeah, I think that is a really interesting point. Is so many people will look and say, "Oh, the stock market is at all-time high," or the stock market, how'd the stock market do today? And really, that's just something on the peripherals almost, right? Like that's where most people are allocated most of their money to, and so that's why they care. But the question they should be asking is, what's the bond market doing, right? And what is the bond market doing from the treasury side, measuring potential risk-off moves? But what's the high-yield market doing, right? Because what's that credit sensitivity is, it's more difficult, not impossible. And I think Mike Green certainly has some interesting thoughts about this and how indexing has affected high yield markets and credit spreads. But as far as like a risk on, risk off, and you're looking at the price, the price movement of bonds, like a directional movement of the price of bonds, particularly on a shorter time frame, it starts to be a better bellwether, because like, retail aren't really out there like, oh man, bonds are down 3%, buy that dip. You know what I mean? If equities are down, so if you think about like in a magnitude, terms, right? If high yields are down, 3% or 5%, that's like the stock market being down 6 to 10%. And that's where people start going, yeah, buy, get the money flow and buy the dip. But the bonds just do it a little bit quicker almost, right? They sell off a little bit earlier. And the reason why is it's got more, for lack of a better term, like brain power behind it, right? That's really looking and doing that fundamental analysis. And you can't hide, right? That you can't fake the fundamentals the same way in the bond market, because it doesn't have to be rational, but it has to be a little bit more rational, right? Because of this calculatable contract.
Definitely. Yeah, that's a good point that you make, and the players are different that create the marketplace.
Yeah.
And so generally speaking, institutions and bond buyers tend to be a little bit more rational, a little bit less volatile as buyers and sellers. The other thing I'd point out there too, though, is there is far less of an ability for gamesmanship within fixed income. The rise of kind of pay for order flow, high frequency trading, these types of phenomena dramatically exacerbate volatility and frankly market bubbles within the equity market, right? Citadel paying for order flow to Robinhood and effectively tripling the amount of buying power that are going into these meme stocks because they're front running the orders.
Yeah.
Right? And so that type of thing has exploded within equity markets and has made equity markets somewhat of a casino as of late, whereas it's just infrastructurally not possible for Citadel and others to do that yet within the context of fixed income, and therefore it is a little bit more steady state inherently.
Yeah. Don't issue the challenge, please, Joe. Don't don't issue the challenge to him.
It's coming, I guarantee it.
At some point, but
Yeah.
it's just, it's a more rational market. Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you. If you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com, and we look forward to talking to you. I think to go back, like, anyone that's been following my podcast right now is thinking, like, why the hell is Branden so excited about bonds right now? Or like, why is he talking about bonds? I'm typically more of a bond bear, right? I'm really big on people now call it the debasement trade, right? I generally think that people should have their largest allocation of their portfolios be to equities, right? I think over time, equities will continue to outperform high yield bonds on a total return basis. They might carry more risk, but I think they'll outperform. And I say that over time because I think the conversation that Howard Marks with Oaktree has been, he's been banging on that drum for the last, I want to say, like, year now almost, right? Like, hey, the valuations are so stretched that if you buy now, it's fine. You can buy now, but over the next 10 years, you're looking at annualized return at this, when you buy this valuation in history, your forward-looking 10-year return has always been every single time plus or minus 2%, right? Over 10 years. And most people would go like, that's an unacceptable outcome for owning equities.
Yeah. No,
it's reality. Now,
totally agree.
I'm obviously, anyone that has me work with their stuff knows I'm generally a tactical guy. So I tend to look at that challenge and say, okay, well, I kind of know that doesn't mean, okay, starting next year, you get plus 2 or minus 2, right? And it's just plus 2 or minus 2 every single year. It doesn't like all of a sudden become not volatile. It just means you might go 2020 minus 50, 15, 25, you know what I mean? Yeah. And so you get the drawdowns, the big drawdowns, typically in those 10-year just following. There tends to be always some year with a really big drawdown, right? And so if you can avoid the big drawdown, your return in equities can be okay, right? But that's a bigger challenge, and most people have been accustomed to and trained to always buy, always hold, never sell, buy every dip, right? And it always sounds great until, hey, the dip is unbuyable because you don't have any cash. It just went all the way. You know what I mean? Like, or maybe you have some cash, but if you have an $800,000 portfolio that just went to 400,000 and you have $5,000, it's insignificant. You can buy the dip if you want. You can time the bottom perfectly. It's just like, it's a rounding error on the outcome in the long run, right? So the larger your portfolio gets, and this is what people I think forget, and this is why people with a lot of money tend to engage and look at things a lot different, because you can't just always buy the dip, right? When the portfolio is large enough that like whatever cash you could come up with to buy the dip is not going to make a difference. It changes everything. And that's where I think the trades around bonds, and especially in the high yield bonds, are really interesting here. And it's not that I actually want to go long bonds here, because I think the same thing that Howard Marks is putting out and saying, look, S&P is going to be plus or minus that, so maybe instead own some high yield bonds, right? I don't know that I love that with how tight the spreads are. Like, that's my opinion, right? And maybe you're different. I don't think you are, but like, I don't really love bonds here because, again, if I'm making 7% a year, contractually, but I lose 25% of my money, it's going to take me a number of years to just dig out of that hole, right? And so once you figure, well, if it takes me 5 years to dig out of that hole, and then I gotta, go another 5 years making 7%, it averages out okay. You probably still do better than the plus or minus 2% on the S&P, but to me, that's still not a return that would excite me, right? Like, I don't get excited about the opportunity of just not getting wiped out but making no return, right? I'm taking risks, so I want to make a good return. What I find interesting is that bonds in particular, for somebody that's interested in liability matching, somebody that's interested in looking different for a period of time. Because remember, if you go 2020 minus 50, you have 2 years of looking really stupid, right? Like you have 2 years of being uncomfortable in the sense of like, man, look at what the stock market did this year. If only we were in the stock market this year instead of high yield bonds, or man, why did we pay for these hedges, or why did we do any of this stuff, right? Those periods of time, and it's so often that last year, right? The last month, it's just like right at the end that it gets everyone, because you've already paid the pain of not being involved in the trade to the upside. And then you forget your thesis, you get the FOMO, you jump in right before the big drawdown and you get smoked. Right.
Yeah. Classic.
And it's the same. It's the same on the downside, right? Like you hold on. And, so you buy Bitcoin at 120 and it goes down and you go, well, it's going to go up to 200. It's going to go up to 200. At 100, you don't sell it. 90, you don't sell it. 80, you don't sell. At 78,000, you sell, and it bottomed at 77 and it ripped back up to 200, right? It's it's so like there is always a point in time in which you're going to feel really foolish as an investor, right? You either feel foolish on the way up, you feel foolish on the way down. Everyone's going to be made to feel foolish at some point, right? Like that's just the nature of investing. I think I'm trying to remember who said it, but they said like investing is just a decision of being right now or being right later. It's like you kind of can't have both, right?
That's fair.
I think the high yield space, because of the ability to hedge on a more mathematically driven basis, to stay a little bit more rational in thought, it provides an interesting opportunity to add convexity to a portfolio where you can add yield, you can add generation, yield generation that way, but in a hedged manner, right? That you're not just taking on all the risk to get a little bit more yield, right? You can actually limit a lot of your risk, and do that. And I think what's interesting is pairing some of that with with stocks in particular, right? If you take a big asymmetric bet in sort of against the bond market potentially, but you still own a bunch of stocks, we know those two things are correlated, right? So there's like going to be very few times that the stock market just crashes and the bond market's fine. Like, I don't even know if that's ever happened. And I don't know that the bond market's ever crashed and the stock market was fine. I don't think that's really ever happened. Like the correlation there on a daily basis isn't 100% perfect, but even on a monthly basis, it's really a pretty tight correlation, right?
Sure. Yeah. No, it's a good point. And actually that's one of my, if I zoom way out, that's one of my favorite trades on a relative value basis right now is being long equity options to the upside and short credit options to the downside, right? And that's because of the mathematical asymmetry that we've already talked about, right? When credit spreads are near that asymptote, where there's only a marginal amount of continued upside left and a ton of downside, it makes sense being short that market just purely quantitatively. Similarly, right, in equity land, you do not want to be short stocks right now, right? I mean, stocks could print another 20% from here, and I would not be surprised.
They could print another 100% from. They really, Joe. I think the markets can be so irrational. You could see 3 more years, 30% a year before
exactly. So why not own a little bit of that upside in the form of a defined risk in call options to the upside that are paid for by my bond portfolio income? And I'm also short the credit market where it's asymmetric to the downside. That's kind of the way we're thinking about the relative value, because to your point, equities can stay irrational for so long. And it reminds me of the dot-com bubble, right? Where all the really smart credit guys in 1997 who were pounding the table saying, we're in a bubble, they were right? But they missed out on 40% plus equity returns for the next 2.5 years. And so, and the flip side of that coin too, right? All of the internet nerds in 1995 and 1996 saying that the internet was going to change the world, they were right too, right? But what they got wrong was the adoption curve versus the excitement of the financials, and that led to capital allocation misuse, which is very similar, I think, to what's going on today. And so, how do we play that? Like, I don't know, and nobody knows when, if we're in an AI bubble, can be debatable. I think we are, but it's what it is. nobody knows when the music's going to stop necessarily, but it's quite possible it goes on for some time. And I do think that investors should have defined risk to the downside that would capture some of that upside potential.
Yeah.
At the same time, you want to be thoughtful about the downside scenarios.
Yeah. Well, it's the downsides that make or break people, as you know, the long term really goes. Those are the years that make all the difference. The upside years are, like they're exciting. Everyone loves returns, but it's the not getting wiped out in the big down years that really makes the generational differences, right?
Yeah. Oh, 100%.
Until you go through some of those as a sizable investor, I know we're working with a client that's currently onboarding, and their point was that they were a DIY investor originally, right? And they had started at Vanguard, and in like 2005 opened their first IRA and started putting money in. And so they said, yeah, well, and so one of their comments was, I saw the downside in 2008. And I said, yeah, but okay, 2005. And back then I think you only put like a couple $1,000s in an IRA. So let's call it $5,000. Okay. So 5,000 in 2005, 5,000 in 2006, 5,000 in 2007. So in 2008, you see a $15,000 portfolio go to $7,500, and you put $5,000 in. You're not feeling horrible. You know what I mean? If you can get past just put the 5,000 in, you don't feel too bad. You know what I mean? Because you go 15,000, it went to 75. Okay. So I'm really at like 12.5, so my 15,000 went to 12,500. I'll lie to myself behaviorally that, the 5,000, isn't gone. And you did the right thing, right? Behaviorally, when your account is that small, you absolutely did the right thing. You bought a massive dip, accounts ripped to the upside, and you keep putting money away in an IRA. And congratulations, you just weathered a storm through what would later be called the Great Financial Crisis, and bought the dip into one of the biggest bull markets of history, right? Like but now the calculus is different. If you stop and you say, okay, now hold on. So you saw 15,000 go to 7,500. Would you really be feeling the same way if you saw 3 million go to 1.5 million? And you're like, well, don't worry, I've got my 5,000 to put in this year. Or I've got even 100,000 to put in this year, right? It's not the same when the numbers get bigger. And so I think, people that are interested in the longer term, that have sizable portfolios, got to think differently about this whole thing.
Totally agree. I think, if you're fortunate enough to have an excess of $5 million in savings, I think this is an unbelievable opportunity to lock in income for the next 5 to 10 years, right? If I had $10 million in the bank, I can build a portfolio, a very risk adjusted, very robust portfolio that's going to kick off anywhere from 500 grand to $1 million a year in income for the next 10 years. And I can have certainty in that, as opposed to relying on equity markets and that volatility. My lifestyle, have that nest egg. And if it does hit the fan, I can always sell the bonds and go buy stocks if the valuations become cheap enough.
Yeah. But you don't want to pile in and just go buying high yield bond fund index funds.
Oh, right?
Goodness, you know what I mean? It's like
you need to be very thoughtful about the portefeuille construction and what that portfolio looks like.
Well, and like liability matching your life, matching your life alone. Before you hop off, I mean, you've done some really interesting research on kind of the bonds around the data centers. I mean, I don't want to put you on the spot. Do you feel comfortable talking about any of that?
At a high level, I'm fine. I'm happy to talk about that. Yeah, sure.
What do you I'm going to put the ball in your court because I don't want to, overstep or overstay my welcome here. But do you think there's any interesting things that you're willing to share at this point about the bond market as it relates to these AI data centers and this sort of thing? And I only bring it up because you mentioned like, you think we're in an AI bubble, and it's kind of this thing of, we're in a bubble, or no, we're not. I would lean towards, if I had to say, I think we're in a bubble, but bubbles can go way bigger than you ever think. And, but I think it's probably somewhere in the middle, right? Is generally
it's a fair question. I think you might be alluding to when I, spoke at that conference in the summer. This was kind of before the market started to get wise to all the private credit deals that are being used and leveraged to fund this massive amount of infrastructure and data center spend. And we alluded to something along the lines of how these loans are making their way into securitizations, right? And so they're taking private credit loans that are being used to fund data center construction, which is a very, very capital intensive endeavor and a very low margin business. And they're taking these loans and they're slicing them up into tranches like a CDO, and they're selling those bonds, the tranche slices, to Wall Street investors and insurance companies. Actually, insurance companies have a ton of this stuff. And for a while, going into this summer, it was the hottest asset class. The most levered bond at the very bottom portion of the capital stack, the riskiest piece of that debt, which was 10 times levered. When those bonds came to new issue, they would be anywhere from 20 to 30 times oversubscribed. That's how much demand was there in excess of the available supply, right?
This is 20 to 30 times.
20 to 30 times the notional value, right? So it's call it a $500 million aggregate bond deal. The B piece at the bottom is a $50 million bond, and there's 30x the amount of demand than that $50 million piece. And by the way, these bonds were being issued every week, right? It's not like there was one every 6 months or something like that, right? And so these bonds were being sold for SOFR plus 250, 300 basis points, right? 300 basis points over effectively the treasury rate. And this is a 10x levered instrument, right? If the cash flows, if the projected cash flows are off by 10%, these bonds could go to zero. And yet there was just this massive amount of hype and demand for these types of instruments. And so we started to get really interested in those loans, and we started to crack those documents open. Since then, there has been a very healthy reevaluation, I think, that the credit market has given. And you can see that in just the BDCs, the business development companies like Blue Owl and others, where private credit very broadly has sold off quite dramatically relative to HYG and high yield publicly traded bonds. And that's a whole different hour-long conversation probably. But the takeaway really there is that there is fresh scrutiny being applied. So, it's not necessarily a trade that we're in right now. We were sourcing that as a potential idea to take the credit default swaps, or at least write credit default swaps against that risky piece of data center debt. But since the whole deluge in kind of reevaluation, things have normalized a bit, which I think is actually very healthy for the market. I still think that a lot of the equity valuations are absolutely preposterous, but as we've said for the last hour, right, that can keep going for quite a while.
Yeah. What kind of revenue do these, like, so if we say, okay, if the business projections are off, the income projections are off by 10%, the bonds fail, right?
Sure. It depends. It's a very case by case basis, but
right. Broadly speaking on aggregate, like what kind of revenue do these data centers actually have to produce? And are the economic output of those data centers going to be able to sustain the use case of that? Or is it a negative carry on a company's balance sheet in total, but the funding from other operations of the business are able to support this sort of, for lack of a better term, a loss leader, right? Similar to, chickens lose Costco money, but in net, they bring in so many customers, they make them money, right?
That's an interesting analogy. I would think the majority of these deals are fine from a balance sheet standpoint, I would say, right? A lot of it's pre-contracted revenue from very reputable, creditworthy customers like Meta, right? Where they're committing to a minimum kind of AI Capex spend at that data center for the next 5 years. And then, but I would say there's such a wide array of terms, negotiated terms and deals that you really, really have to look on a case-by-case basis. And the rising tide really is lifting all boats right now, meaning that there are some deals that are just atrocious looking in terms of the risk profile, right? Like, sure, on paper, company X is committing $5 billion in revenue over the course of 5 years, $1 billion a year. I'm making all this up, by the way, as an example, but there's all sorts of outs, right? So if the demand for AI does not meet the expectations, the hockey stick projections that everybody's accounting for, projecting right now, then company X has the option to get out of the lease, so to speak, early, right?
Mm-hmm.
And so those types of options that are embedded all over the place are kind of like a key catalyst in our view. Is if adoption rates don't meet the very, very frothy expectations over the next 2 years, then there's going to be a lot of canceled leases, and those are the types of situations where these projects are going to be underwater in a hurry, right? They need that revenue right away because of the amount of debt that they're taking on just to build the building, let alone be free cash flow positive.
And so that raises a good question I want to clarify is like when these buildings are getting built, the data centers are getting built, it's not that Facebook is going out and they buy a piece of land, they spend money to build the building, they spend money on all the servers, they put it all in and they operate it, right? And they issue some debt in order to do it. What they're doing is Meta's finding some kind of real estate developer or real estate group and saying, if you build a building that we can put our servers in, we'll sign a lease. So we'll give you an LOI. We'll commit to a lease. Basically, you go get the land, you go get the building, you put it up, you take the risk of ownership. We'll lease it. And what you're saying is in their contracts, there's all these interesting case by case, like, ways to weasel out of the contract, so to speak, right? And get out of the lease.
It's an option. Yeah, exactly.
Like
there are some deals where you'd be shocked. I'm not going to name names and but there's a publicly traded company that is involved in this AI infrastructure data center build out where they went out publicly with a PR newswire and touted this huge development project that they're going to be doing in Texas or wherever. And, you read the fine print and it was, they're touting like a $10 billion aggregate, project. And the only thing that they actually acquired, they spent $200,000 ish on an option to buy the land to then go and develop the infrastructure. Like they had no money to actually do the project itself. All they did was acquire the option and then they used that to go promote it and headline it to try to then raise the money and take advantage of all the hype to go and actually commit to the project itself. And so like that rising tide is allowing for all sorts of uninvestable projects where there's really nothing but smoke and mirrors.
Yeah. Well, I think this is the credit cycle that Ray Dalio talks about, right? Is eventually it has to get paid back. And so what happens is, and this is why people forget, like recessions are something that we think just shouldn't happen anymore, right? Like recessions, if there's a recession, they'll just print more money and that will solve all problems. And if you think I'm being serious about that, just remember I'm extremely long gold and that trade's been working out okay for us. The recessions are good because it clears out the bad actors of the economy, right? It clears out the unprofitable business and it allows for the economy to reallocate capital to the productive pieces of the economy where capital's put to work in the most efficient, highest and best use. And the unfortunate part of recessions is people have, very tough circumstances on an individual basis, obviously. And companies do go, and that's largely a function of companies do go out of business, right? But the good actors, the people that do run clean balance sheets, that have good business operations, that are good operators, they survive. It may be uncomfortable, but they survive and they come out stronger the other side. And so an economy becomes more resilient in the long run. And that's what allows an economy to then go on another, bull run, if you will. Right.
For sure.
And what you're saying is, hey, kind of right now you're getting the good and the bad, right? Because things are so good and the tide's rising that even the stuff that maybe shouldn't be making it through, there's just so much exuberance or so much demand or interest that people are they're sneaking through the stuff that's, probably not going to work out in the long run. Right.
Absolutely. Absolutely. There's no question about that. And I mean, to your point earlier, also just to kind of revisit that last point, the reason that Meta and Google and OpenAI even, right, the reason that they're not actually going out and building the data centers themselves, they're contracting it to developers, is telling in its own right. right? Because these companies like Google, they know that that is a terrible business model, and it's very, very cyclical and very reliant on the ability to refinance debt in capital markets.
Mm-hmm.
And those types of real estate development projects are a totally different asset class and business model than anything to do with Mag 7. And so they've kind of intelligently stayed out. Yet there's hundreds of billions being poured into this development, and it's definitely a precarious spot to be.
Well, that's what real estate is often about, the biggest winners are the developers, generally the developers.
Yeah, that's true. If they're willing to take the risk.
Well, and the reason why is, right. So if you look at, if we look at the AI Capex trade right now, right? Okay. Who wins in that trade? Well, the guy that builds, the guy that takes the risk, like how much risk are you really taking to, if you get a piece of property under contract, you haven't even paid for the land, but you went out and got under contract, and then you went and pitched Meta, or Google or whoever, hey, we'll build a building here if you commit to a 5-year lease. They go through 12 months, do the build out, get the lease signed, stabilize it, and then they go, cool, now we're going to sell it.
Yeah.
And they just take their cash and leave. And exactly. Somebody else is going to buy it thinking like, man, we're going to depreciate it. We're buying this thing at a 4 cap. They're going to get smoked on it when interest rates go up. They're not going to be able to refinance.
There's these at treasury rates.
Yeah. There's tiny little, there's little loopholes in the lease that, these big guys are going to, take them, like you're going to own a building and you think you're going to win a lawsuit against, tech giants, be my guest, but you'll go bankrupt trying, you know what I mean? Like you're going to go bankrupt before you actually settle out the lawsuit is my guess. And even if you win out the lawsuit, you're left with a building that's purpose built for a data center. You got to try to get another person in there running a data center. And obviously the biggest guys already said, well, that's not a profitable use case. So you're left with an asset that's not really, I think, highest and best use of what most people would want to be seen done with their capital, but people aren't thinking critically that way now.
Well, that's a whole different conversation too, is, what happens when there's a new technology that's available, in these, whatever, H200 chips or whatever are obsolete, Blackwell chips become obsolete. How much retooling is going to have to exist across the existing data center infrastructure? Yeah. And, what does that CapEx cycle look like? And it's a similar thing, honestly, with electric cars. Something that we've been kind of worried about for a while is at some point, lithium ion is going to be a thing of the past, and they'll develop some new technology. It's already, solid state batteries are already being worked on. And you've got Ford and GM and all these other manufacturers who have taken on tens of billions of dollars of debt to build out these lithium ion factories. Yeah. And they're going to need to do that all over again for the next generation of technology. And a lot of the balance sheets aren't going to be able to afford using debt capital markets to finance the new generation. And so that turn of innovation as it relates to actually retooling the means of production to output the new generation of technology is, I think, a very underappreciated factor as well.
Yeah, no, I'm with you on that. And I think technology will likely advance as quick as it always has, right? I mean, people forget it. What was it? A 60-year span between the Wright brothers' first flight and putting somebody on the moon?
Yeah. If anything, I think it's exponentially compounding.
Yeah,
but the rate of change is just getting faster and faster and faster.
Right. No, it has, and yes. So the growth of technology or the adoption is exponential, right? It doesn't just taper off. It's kind of the opposite, right? And so, how fast will it be before we replace the Blackwell chip? And to a certain point, though, like technology can potentially outstrip demand, right? When there just is technology that beats essentially the use case in the real economy, because the real economy still has to function. So you can't just infinitely build data centers because a model says there should be infinite demand for data centers, right? Or infinite demand for processing. And so, yeah, what happens when, they come out with the next series of chips or 2 or 3 generations from now, you can fit, all of the processing you need in a quarter of the space, right? You don't need 1,000 data centers anymore. You need 200 data centers.
Well, that's the risk coming out of China right now, right? Is all that all the open source LLMs in China,
yeah,
doing things much more efficiently. I mean, that's another completely unappreciated risk in our view. And look, I'm not
yeah,
an expert on this technology at
yeah,
all, but it seems to be like one of the two is going to win. It's either going to
yeah,
be kind of the gated technology where everything's somewhat proprietary from business to business, or it's
yeah.
going to be open source, hyper efficient. And I kind of think that might actually win, in which case this Capex spend is going to, that's not going to end well at all.
Well, it's like I hate to be the analog guy, right? And say it's just like that, just like .com, like it makes me sick in the stomach to be that guy. But we should remind ourselves as investors, right? When there's these periods of just, things will go to the moon, right? You should almost kick yourself in the gut a little bit and be like, let's remember reality a little bit. Part of being long-term is remembering that bad things or unsavory things do happen. And how do we be prepared for that? And there is however many, thousands and thousands of miles of, fiber optic cable laid beneath the ocean from the .com era that was still, you know what I mean? Never used, still there. And so will there be data centers that get built and really never used? I don't know. Right. I just think at a minimum, it's a situation where I think people should be looking around and saying, if this were to go wrong, how would it look? How would this impact me or my portfolio or my financial life? And am I taking any steps to mitigate that? Or am I just going to just hope for the best here? And listen, this is America. If you think it's going to just turn out great, it is your God-given right to go full long, max port the leverage, own the cheap beta. You know what I mean? Do whatever you want. But if, it's also your right. If you think it's maybe, not going to turn out 100% as intended, you've got the ability to make some choices and try to hedge off your risks or manage your risk or change up the design of your financial plan, right? That then has the portfolio implications that you go and implement. But, potato, everyone's, like,
I agree.
Interesting time we're at. Interesting time that we're at. So
that's for sure.
Well, I hope the AI trade works out. You know what I mean? It'll be awesome. Like, and I hope everyone makes stupid amount of money, right? Like, I wish the best for people.
There's definitely, there's a saying that empirically holds true, at least in my experience, and optimists always make more money over the long haul.
Mm-hmm.
Like it's just true. You can't be a cynic in this industry. You're just going to get killed. And so, I am optimistic over the long term and just somewhat skeptical on a cyclical basis. The hockey stick projections as it relates to demand and usage of gigawatt energy or power, and how that translates into net income.
Yeah.
Two things could happen, to your point, to disappoint, right? Like, on the one hand, the demand could just not be there, as expected, which, could be true, maybe not. It probably takes longer for the demand curve to pick up, but than projected, but whatever. But then the other way is actually for the efficiency of the technology itself to improve. And I think that's inevitable. Mm-hmm. And if the efficiency of the technology improves and the amount of energy that's required is going to be less and less, even if consumption does meet expectations. Yeah. And so there's kind of those two competing, and I think the truth is probably somewhere in the middle. But in general, when we see sky high valuations, founders spinning out of a company with no business model, no product, far from any revenue, and certainly far from any net income, and raising billions of dollars out of $25 billion valuation, that just sends off the alarm bells in our view. And I'm happy clipping 8 to 12% and sleeping at night. That's not to say I'm all in on that trade, right? I just want to have dry powder should things normalize and mean revert. effectively, right? I think that it makes sense to a degree to tactically own some of these exposures to the upside, especially in the form of options. But that's our bias right now, is to be as defensive as possible.
Yeah. Yeah. Well, I appreciate you. I appreciate the thought. I think that's a good it's a good place to wrap it up on. I think, prudence always pays in the long run is kind of my, one of my thoughts, right? So
For sure.
do with that what you will. But Joe, I always appreciate your time. You're, in my opinion, a wealth of knowledge and have some really interesting insights every time we talk. So appreciate you being able to get on the chair.
Yeah. Thanks for having me on.
Yeah, absolutely. All right. Well, nothing else. We'll see you in a couple months when I'm down in Scottsdale.
Sounds good.
Hope you have a great holidays.
Yeah, you too. Take care.